Hello everyone, I am your host Shayanta and welcome to the show. This Friday, on the 5th of August, the RBI has again raised its repo rate for the third time since April by 50 base points, and it has now shot up to from a 20-year-old low of 4% to a whopping 5.4% in a very short span of time. It has almost come to its pre-pandemic levels. But why is the RBI suddenly in a hurry to increase the interest rates? What are its implications in you, me, and the general citizen of India, and as a whole, the Indian economy? To answer these questions, we have a very special person with us. We have Professor Saibal Kar with us today. He is currently the RBI Chair Professor of the Industrial Economics at the Center for Studies in Social Sciences in Calcutta. He is also the Honorable Director of the Eastern Regional Center of the Indian Council of Social Science Research, and he is also the Managing Editor of the South Asian Journal of Macroeconomics and Public Finances. Welcome, sir, to the show.
Good morning, Sharanto, and good morning to all the audience here. I'm very happy to be in your show, and I've tried to respond to some of the issues that you raised as part of the introduction.
Thank you, sir. We are delighted to have you here too. So we will begin this question with a why. Why do you think the RBI is on a sudden spree to increase the repo rate? Is this something that is expected just after pandemic, or it has taken you by surprise too?
It's a very important question, Sharanto, as we were discussing before the show, is that you see, in terms of the policy choices that the Reserve Bank of India has in its folds, it's either the interest rate that they can play around with or the money supply. So it has to be one of the two policies that the Reserve Bank of India has to take in order to address something which is quite essential in terms of the day-to-day activities of the people in the country. And that concerns the inflation rate as of now, because since we do come across different statistics and different information, you probably know that the inflation rate is going at about 7.1% in the last few months, and it's actually fluctuating between 7.1 and 7.6%, which is beyond the mandated range that RBI has accepted for the inflation to vary, which is between 2 and 6%. So RBI had to do something about the containment of inflation beyond what its acceptable zone. And in that case, using the repo rate to influence the interest rate in the market is the only proximate way to address this issue in the short to medium run. In terms of the surprise, RBI had to do something, so I'm not surprised in the way the policy has been implemented. But what is definitely surprising is that there is a trade-off between RBI's policy and how the Ministry of Finance looks at another important aspect of any given economy, which is the growth rate. So if the rise in interest rate affects the growth rate in the short to medium run, then the RBI is always under pressure to not implement something which it thinks is the right way to address inflation. And that has happened in the past also, that the Reserve Bank of India governors and responsible authorities could not implement what is right from the RBI's point of view, because there was external pressure on the monetary authorities not to hurt the growth prospect of the country. So in that sense, it's definitely surprising that the governor has actually chosen to do what is right for the RBI from an autonomous point of view.
Okay, so what we see here is main reason is to control the inflation, right? And if we
Absolutely.
talk about the inflation, it is something that is going globally. It is right now a global inflation, even as you said, like in the US market as well as in the other countries also, the government and the central banks are coming up with similar kinds of policies. So if we see the global reason for the inflation is mostly driven by the semiconductor shortage and the Russia-Ukraine war and stuff like that. So, but how I derive is it is a supply-led inflation rather than a demand-led inflation, where the shortage of supply is like a run is what is happening. So, do you think controlling the interest rate has an effect on can control a supply-led inflation? For example, the money we have the money. It's not like the money is the problem. It's just the supply is not there. So how do you say that? How do you believe that the inflation rate tweaking of the interest rate will help us control a supply-led inflation?
Yes, absolutely. This is a great question actually, and in fact, we have to grapple with this kind of questions time and again, because you are absolutely correct in saying that the problem of inflation, which is hurting both America, North America, some of the European countries, is either the Russia-Ukraine war, which has cut back on or made the shortage of supply of oil and gas and many other things, even cereals to some extent, which has led to a supply crisis and therefore a rise in price through, and it's most, if you talk about the typical macroeconomic parlance, then it's a cost push inflation because the costs have gone up of producing certain things. So supply is hurt by the rising cost of producing this kind of things. And the looming crisis in East Asia, the China-Taiwan crisis could also be one of those where the semiconductor use and semiconductor production would be absolutely hampered because Taiwan is a huge producer of semiconductors for the rest of the world to use for everything from mobile phones to computer chips to our automobile parts and all that. So yes, I mean, taking money away from people's hand would not exactly address this issue. But what it definitely has to do with is, in the short run, if you do not have enough supply, right, but people still have money to run after that shortage of supply, right, there would be like a top up of inflation coming also from the crisis of excess demand, given that supply is not adequate, right? So the rise in interest rate would address this additional top-up inflationary pressure on the Indian economy. That's the usual way of handling inflationary pressure until the supply eases out, right? So it's also the thing that the Federal Reserve in United States is doing, that it's controlling the interest rate. It's raising the interest rate as the Fed hike often does, and therefore the quantitative easing, which created a problem again back in 2013 after the previous worldwide economic crisis. It can also lead to flight of reserves and flight of resources from some of the developing economies and some of the so-called economies which are dependent on foreign capital to an extent. So in a way, it might hurt supply little bit also because we are dependent on such funding, such finances to keep on producing some of the commodities as well as services. So that would be hard. Growth would be affected because of this. And yet, in the short run, RBI, which I partially believe it would be able to do, is take away the bite from the additional demand because supply is deficient for the period, right? So it would have to wait until the supply catches up.
Okay. So you just now talked about that there are two levers basically. One is the repo rate, and another one is the money supply that they can control. So, from your experience, what do you think that the RBI can also do apart from the repo rate tweaking? Like, for example, is there any other tool that the RBI can implement to control the inflation, or this is the only way that you believe that they can do this control of the inflation?
Well, what RBI or any central bank has in its sleeves is either the interest rate or the or tweaking the money supply, right? So it's either printing money or taking money back from the people in some way, either through the interest rate or just printing less money in every period for circulation. So beyond that, Reserve Bank of India does not have any other monetary policy tools. So it has to be one of these which must be played around with. In terms of money supply, what it can often do is, for example, if there's a huge amount of foreign exchange reserve that's sitting with the Reserve Bank of India, it might not want to bring it all the way, translate that fund into from reserve into the Indian economy or the local economy. So, which would also mean inflationary pressure further on the local economy. It can avoid doing that for a while, and therefore piling up of foreign exchange reserve will have its cost, even in the short and medium run. So there was a time, some of you might remember. I mean, you are pretty young, but some of older people would remember that India was accumulating too much of foreign exchange reserve, right? And like we say in economics, that no lunch is free. So accumulating foreign exchange reserve is like it's a good thing, apparently speaking, that
Absolutely.
we are okay to import as much as we want. We would not face food crisis or oil crisis for a foreseeable period of time. But the thing is that accumulated reserve would have an inflationary pressure on the economy, even when sitting in the Reserve Bank of India, because people know that we have this foreign exchange reserve, which can be monetized into the local economy and therefore turned into rupee. Every dollar turned into rupee, and that would give you additional purchasing power. So what Reserve Bank of India could do, and actually did partially at the time, was lend this foreign exchange reserve to some of the deficient countries. Right? So for example, Afghanistan would need foreign exchange reserve, or Nepal would need foreign exchange reserve, and India could lend that and even earn interest rate for the short to medium run, and while not using that foreign exchange reserve in the local economy, so that the inflation is also under control. So that's something in RBI can always do in order to control inflation along with interest rate changes.
Okay. Now, talking about people, as a normal Indian citizen like you and me, how do you see this in repo rate changing? What are the implications that can trickle down to the common man? Uh, if I have to ask you that.
Yeah, absolutely. See, the repo rate, the full form, as we know, is the repurchasing option, right? So it is the banks lending, or the central banks lending to all the commercial banks. And the reverse repo rate, similarly, would mean that the banks buy it back from the Reserve Bank of India, because they either need more money or less money, depending on how it wants to find the lending market more attractive or not, right? So when the repo rate is raised by the central bank, it means that the banks have to borrow at a higher cost from the central bank, right? Which raises their cost of lending further, and this translates over into our day-to-day interest rate that we face with, say, housing borrowings, housing loans, car loans, or any consumer loans, including the industrial loans, because large and medium-sized firms often borrow, and we do see this kind of newspaper reports coming out often, that, for example, Mr. Adani has pledged the State Bank of India for 14,000 crore lending from the bank, which again would have to be sensitive to how the interest rate behaves during this period. So if the repo rate is high, banks obviously translate that into interest rate, which is going to be higher for everybody, like you and me, or any borrower from the banks. So and the usual reaction on the part of people happens that as the interest rate goes higher and higher, we tend to borrow less, right? So we would try to borrow less from the bank, wait for the interest rate to go down, which is going to hit the market in terms of our purchase for real estate, for automobile, for anything else, where we need money to supplement our own funding and own finances, right? So our EMI costs are going to rise. For those who are already contracted on a flexible interest rate with the bank, will see a higher interest rate coming for their EMI. Or if the interest rate is fixed as per the previous contract between the consumer and the bank, then the period of EMIs are going to go up, right? So you have to keep paying EMI for a longer period, because if you contract a given interest rate, but the bank's cost of lending you has gone up, bank could raise the number of years or number of months for which you have taken the EMI. So it's going to hurt the consumer like you and me in some way or the other. But the other good thing is that it's also going to raise the interest rate we get from our term deposits with the banks, right? So we have fixed deposits in the bank, and older people are particularly concerned about that. So, for example, those who have retired and do not have pension or social security provisions, for a country like India, we do not have social security provisions other than what you save. So the fixed deposits earn you some interest rate on the basis of which you run your cost of living and your expenditures on a monthly basis. That fixed deposit rate are going to get a rise as well, because banks pay you more as the interest rates go up. So it's a
Uh,
weighing on both sides. It's a cost benefit kind of thing for the consumer. So if the fixed deposit rates are higher and you are a borrower from the same financial market, you have to see how the balance stands. So it might go up to 8%, 8.5% for EMIs on housing as percentage of interest rate. But people are waiting to see if the FD rate also starts hitting 8%, which is like a magic figure that makes a decent return on the fixed deposits and term deposits. So it's a
yes, I
balancing act.
Yes, I remember a few years back when I used to have my FDs and stuff in bank. I used to, I see my passbook and used to go at 8 or 7.5, and right now it has dropped to almost 4.5. 4.5 is also very good, by the way. Like
Absolutely, absolutely,
3.5
yeah.
private banks, 3.9 or 3.5. So I hope the situations will improve. And as you said, and one more thing I wanted to ask, that the rate that you're talking about, the banks have a like the contract between the consumer and the bank. They have a different rate, and sometimes the rates are fixed. I think the term is called the floating rate of interest, right? And the fixed
Floating and fixed rates, yes, absolutely.
floating and fixed rate, right? Yes, yes.
Yeah.
And one more thing, one more thing I wanted to ask, that in the coming this year, do you think that the further hikes are in place that the RBI is planning to do, or this is something which you believe that okay, if the rate comes below the prescribed 2 to 6%, then the RBI will say that okay, that's enough, or do you see further increase in the repo rate, or how do you see in the next coming month the consumer should be prepared?
Yeah, it's a predictive question. My first reaction is that the predictors in the interest rate market are actually saying that RBI is going to raise it further, at least one more time in the next 2 or 3 quarters to about another 50 basis point, 50 to 75 basis point. And the reason for why RBI might actually do that still is that the inflation rate is coming majorly from the production of agricultural commodities. So if you look at the food price inflation, it has been way more than what the RBI would accept as a given range. Food price inflation has been almost about 17%, which is quite beyond a common person's acceptable limits, because the vegetables and consumables on a day-to-day basis, including oil price, the price of what they call is the lubricants in several ways, they have gone up, not only because the petroleum price is still going up, the rupee is becoming weaker in the international market. These are all accumulated effects on the local economy on which the RBI has to act, right? So RBI is taking all of these things into its calculation, right? To think whether it should continue with the same interest rate, same repo rate, or it should raise it further. So if the production of agricultural commodities is better, we have to depend on monsoon, because India is still very dependent on monsoon. And if you are from Kolkata or West Bengal this time, you know that the monsoon has been 50% short. So there would be some problem with agricultural crop production, vegetable production, which might get affected by the ensuing drought. And if that drought happens, which has happened in Australia big time, even during this year, some portions of Europe is suffering from drought. You just saw the extreme temperatures in Western Europe. Who would know that the UK suffers from 40 degrees? It's like temperature somewhere in India. And this would all have a global impact on food production. So if this continues, then RBI would have no option but to keep raising the interest rate or the repo rate to an extent, so that the short-term impact on inflation is curbed to an extent which they would prefer as inflation targeting.
Okay. So one thing, since what we are seeing, has this kind of, from your experience, before we conclude, have you ever seen this kind of situation, say, for example, in 2013 or 2008? Have you ever seen this kind of situation playing out in the world economy? And previously, how have India responded to, or the RBI has responded to such situations, and how it is doing differently this time, or it is just boilerplate stuff that RBI is doing? So how do you compare the history of the last 10 years with RBI policies when such things occur, and how do you see this time it is acting?
Yeah, it's a difficult question, Shayan, though I might not do justice to the historical facts. But the usual tendency would be that RBI has to make a policy decision based on the diagnosis of where the inflation is coming from. As you said in the beginning, whether it's a demand push inflation or it's a supply crisis driven inflation. So if you talk about the 2008 crisis, we know that it was a financial crisis to a large extent. And because the Indian finances and everything were not that formalized to a large extent, I mean, of course, some of the big real estate firms got affected by that. Some of the banks got affected by that. And you can even take it back to the so-called, the famous East Asian crisis of 1990s, when the withdrawal of finances from many of these Asian countries, including say, Singapore, Thailand, Malaysia, Hong Kong, still left India untouched to a large extent because we did not have the convertibility of our foreign exchange reserves or of our capital account to a fullest extent. But we do have that now. So I'm actually bringing in some of these issues which were, Professor Abhijit Banerjee at that point, a term that has hard behavior on the part of the financial companies, which withdrew money just on the flicker of information, maybe partly misinformation. But that's not happening in the current scenario, right? So 2008 was a different kind of crisis. So RBI did not have to react until 2013, because if you look at the Indian economy's performance between 2008 and 2010, Indian economy was not too harshly affected, although the Western economies were reeling from the crisis at the time, because our finances are still very informal in many ways. So RBI did not have to interject either the money supply or the interest rate in order to address the looming crisis. But this time RBI is doing it pretty autonomously, in the sense that the food price inflation and the retail market inflation is something that RBI does not think is going to subside just by itself. Otherwise, RBI stays with the interest rate chosen in the previous period. As you said in the beginning, that it reduced it before the pandemic because the economy needed some boosting up, it needed some investment support from the people and the investors. So RBI reduced the interest rate at the time, repo rate at the time, and it's just reversing the policy as of now because the requirement is different. So it has to be the diagnosis of what is causing the crisis, and RBI has to make a reaction on the basis of that.
Okay. Thank you, sir. It has been really an insightful conversation with you. And I think our audience will have a lot of things to take back. And really, really thank you for your time.
Thank you so much. I hope the discussion would be meaningful to the people who are actually thinking about policies and how the policies really affect our lives on a day-to-day basis. So this is a translation from macroeconomic policies to what is really very micro, on the ground kind of effects on us. I thank you so much for inviting me. I hope we'll have some more interactions in future.
Thank you so much, sir.
Thank you.